The way they discuss their positions is first non-commercial, second commercial, and then lastly non-reportable positions. Now non-commercial investors are the investors that, what we discussed before, are large speculators. Those people who have to report their positions, but they're not really hedgers into the market. So these are the non-commercials. Commercials are the hedgers, and there's an actual designation when you open up an account that you have to check, and you have to say you're a hedger, and you have to explain what type of hedger you are in order to get the discounts that hedgers would receive. And so this is a very accurate assessment of who's investing, and who's investing as a hedger, and who's investing as just a large speculator. Now lastly, there's non-reportable positions. Non-reportable positions are unique in the fact that that's just you and I. We are the small speculators. We don't have to report how many contracts we hold on to, but they still collect the data on the number of contracts we're holding and how many on which side. So then we go to the second level and we look that under the non-commercials we have a long, a short, and then the spreading, because non-commercials like to spread. They'll be long one contract, short the other, and try and take a profit in the middle. Very typical behavior of the majors because they have to protect themselves. Being large speculators, holding on to sometimes, I believe we talked about it earlier, in the single stock futures, 200 positions is reportable. So holding on to 200 positions, they tend to be a lot tighter in where their stops are going to be and will enter into spread positions in order to protect themselves. And then you have the commercials. Commercials don't participate in spreading. Either they're long or short. And the commercials operate this way because, as we said before, the shorts are treated as if they have a real cash position, and the longs are treated as if they're going to acquire a cash position or sell something in the future that's going to be a cash position. So there is no, they have a built-in spread. So there's typically no spreading with the commercials at all in the market. And then we have the total of the two, and then we have the non-reportables and the positions that they hold. Now, as we go down, we see the commitments. The word commitments just means the number of contracts that they've committed to in the marketplace. It's not anything more fancy than that. And as we look over here at the circled area, we look at what the commercials are doing. Now, the commercials are long and short, and it shows the actual amounts that they're long and short. 41,566 is the long, and 49,341 is the short. Right there, we can immediately see that there's a 7,000 contract discrepancy between the longs and the shorts, which tends to indicate that the shorts have dominance in this area, and that most likely this market at some point is going to turn down. Now, what makes this interesting is when we look back at the non-commercials hold a total of 22,879 long positions and 9,511 short positions, almost diametrically opposed to the commercials. The non-commercials, or the large speculators, are very bullish on this market. But you have to kind of ask yourself, how important is that when the commercials have a 2-to-1 advantage on the longs and a 5-to-1 advantage on the shorts? Typically, in this kind of battle, the commercials end up winning in the long run. And you can look at this also when you see the non-reportable positions. In our non-reportable positions, we have longs at 21,043 and shorts at 26,636. So the commercials definitely outweigh the large speculators and the small speculators. And they even up when you kind of mesh the groups together. But even still, the commercials tend to have a sway on where the market is going to head. And especially when you start getting closer to the near end of the contracts, as we discussed earlier. Here's another example of the commitment of traders report. Again, this is a short form, very simple and easy to look at. There's a lot of amazing things going on here. We look at the commitments and we look at the non-commercials, and they have longs of 131,000 contracts. We see the shorts with 69,860 contracts. But we just move a little bit over and we look at the circle area and we see that the commercials are long over 383,000 contracts. That's a huge number. In fact, that's 3-to-1 in the long column. So you can see that the commercials can really throw their weight around. But when we move over and we look at the shorts that the commercials have, they have over 454,000 contracts that are short, over 100,000 discrepancy between long and short. So there's definitely at some point going to be a short move here. And in fact, we compare that to the non-commercials, and it's practically 10 to 1. Yeah, basically practically a 10 to 1 difference between the shorts on the non-commercial and the shorts on the commercial side. And this kind of shows you that oftentimes the large speculators may be a little bit behind the curve. When you look at this and you see such a large discrepancy, it can only mean that there's something that the commercials know that the large speculators simply don't know. And this is even expressed when you look at the small speculators like us in the non-reportable positions and see that it's practically even between the longs and shorts. There's only a 9,000 difference between the two. So the commercials are definitely looking to drive this price down. And as we saw earlier, right now, crude oil, light sweet, it was in an inverted market. And so there was a lot of aggression, a lot of the price has been driven up. But at some point, there's going to be a turning where the commercials and their shorts win out. As we spoke before, there are over 11 exchanges in the United States. But of those exchanges, there are really only 6 of them that have a commitment of traders report attached to them. All their contracts do. So it's really to your advantage to find out, check them out, and once you decide what markets you want to trade, to refer back to them. The Chicago Board of Trade has contracts. They're the ones who do the mini Dow. You have the Chicago Mercantile Exchange, which trades currencies and the live cattle and the live hog. You have the Kansas City Board of Trade, which trades primarily wheat, and they also have a value line index contract and a New York Stock Exchange contract that's traded, which has a commitment of traders report. You have the Minneapolis Grain Exchange, which is just focuses on a particular type of wheat. And you have New York Mercantile Exchange, which also includes metals and oil and natural gas. And then you have the New York Board of Trade, which has a lot of the softs, and they also, such as sugar, cocoa, orange juice, and then they also trade some type of currencies. So there are commitment of traders reports in all of these markets. And again, it gives you a behind-the-scenes look at who's trading what, how much they're trading, and when they're trading. There's no parallel in the investment industry to this exactly, where the government is actually telling you insider information of what's going on, and they do it on a weekly basis. Now here's an example of a chart of the dollar index, which can be found on the Chicago Mercantile Exchange. And what I did was I took time frames in which the commitment of traders report was listed, because since they come out every week, I took 3 different time frames, and just to kind of show you what happens with the commercials and how they trade, and how their effect oftentimes is not seen immediately, but eventually shows up. On December 22nd, 2003, we had longs at 13,427, and the commercial shorts were at 2,410. So definitely the longs had a distinct advantage. Now, because the report comes out weekly, another report was put out on December 30th. And once again, we see a strengthening of the long positions that the commercials have, pushing it to 15,224. Then we look at the shorts, and they only moved up 100 points. So the shorts and the commercials are very weak at this time. But the market still is trending downward in the dollar index. Then we shift over to the third installment, or the third week, and we see that on January 6th, the longs have backed off from their high of the week earlier and have dropped down to 14,712. And the shorts had increased by 300 points to 2,828. The reason why this is important to look at this is that, for me, the second week just really didn't matter. I prefer to look at the first, like the reports used to come out once every other week. The first week and the third week are very clear. It still shows that there's strength in the market. There was an up move, and yes, all those shorts had increased their positions. The longs were definitely in control of the commercial setting.